Chris Silvestre, thanks for joining me.
Thanks so much for having me.
All right, Chris, you're an analyst on our U.S. equity team, and inflation's obviously been a major point of focus for investors over the past 18 months. And so this might be very basic, but can you just explain why inflation's potentially such a problem for companies?
Yeah, definitely. I think it's a great question, a good one to recap. So I guess there's two major potential impacts. The first is that it raises the cost of doing business. So that's the most obvious one that investors would be concerned about. It increases expenses, and to the extent that businesses can't pass on those expenses in the form of higher prices, you get reductions to earnings. So that's one major part of it. The second major part of it is a reduction in real purchasing power. So we know that wages have been increasing, but at the same time, real wages have actually not kept up with inflation. So you have a situation where consumers have less to spend overall, less real purchasing power, and have to start making decisions about where to spend money. And that creates some winners and losers where before you may not have had that tension. So those are kind of the two major reasons why inflation is generally considered a problem for businesses.
And the third, just from an investing perspective, would be the discount rate.
Yeah, the discount rate, of course. If we're talking about other than kind of fundamentals, yes, from a valuation perspective, you would get rising interest rates, present value of cash flows would be lower, and you get kind of a second impact on stock prices.
Okay. Well, let's stick with the companies and their cash flows. We're recording this sort of mid-January, and the last 3 or 4 inflation prints in the U.S. have, they've been encouraging in the sense that inflation has, it's still high, but it's steadily coming down. And we've seen a kind of a broad market rally from that perspective. Is there anything you think that either the market's missing or perhaps more specific, again, to those company fundamentals and cash flows that you think investors should be aware of?
Yeah, another great question. So I think you're right. There's encouraging signs that inflation is finally ebbing, and investors obviously seem optimistic about that. And there's probably a thought or an assumption that once this period of inflation has passed us by or started moderating as it is, that companies are out of the woods. I think it may not be as simple as investors are maybe hoping. And there's two kind of reasons why that may be the case. And it essentially has to do with the lagging impact of inflation on some financial statement items. Investors obviously use financial statements to determine how their businesses are doing, and the numbers in those financial statements are related usually to the valuation that you place on a business. So those two impacts are capital expenditures and inventory. So we can go through each of them, but essentially, inflation isn't reflected in real time on those income statement items. They actually happen with a lag. And as a result, we may get some impacts from inflation that don't show up in the financial statements until later on. So that's one area that we're watching closely, and it impacts different businesses differently.
Okay, well, let's get into those. Let's dig into the accounting and unpack them. Let's start with the first one. You mentioned capital expenditures. What goes on there?
For sure. So if you think about how investors value businesses, I guess there's a whole number of ways that that's done, depending on which type of investor you are. But classically, you're looking at price to earnings or maybe price to free cash flow. So you're looking at the earnings power, the free cash flow generating power of a business. You're placing some multiple on that or thinking about how those are going to grow over time, discounting them to present, and then getting your valuation for your business. So when you talk about capital expenditures, this is maybe a more obvious one where there's a difference between the income statement impact and the cash flow statement impact. Of course, on the income statement, you're getting depreciation, which is a historical number that reflects historical expenses spread over time as you use those assets. Of course, the cash flow statement impact is a real-time impact. So capital expenditures on the cash flow statement reflect money going out the door today to replace those assets. And oftentimes, there's a difference between those two. Depreciation and amortization is lower than capital expenditures. In the past decade or maybe 2 decades, the gap between those two numbers may not have been large enough for investors to pay a lot of attention to that gap. But of course, if you have a period of rising inflation, that gap can increase pretty rapidly and pretty sizably. And I have an example if you'd like one.
I was just going to, interested in your example, but more, like if I think about it, so if I've got a factory and I built it 15 years ago and I thought it would have a 20-year useful life, the depreciation expense on my income statement is based on that historical cost.
Correct.
And so I still may be good for the next 5 years, but when I need to rebuild my factory in an era of higher inflation, I'm going to have to pay a lot more for that. And so whereas the inflation may be coming in CPI today, I think your point is, well, when you go to rebuild that factory, the impact on your earnings might be a couple years out. Am I understanding that right?
Yeah, that's exactly right. Maybe one where the impact is closer would be maybe maintenance capital expenditures, right? So these things happen per year instead of kind of taking a 15-year gap, because then it's a little harder to judge. But maintenance capital expenditures, why don't we just go to the example? Because I think this is a good demonstration of it. So we own a company, a very high quality business in our US equity strategy, Dollar General. Dollar General is building out its footprint of stores, still has a very robust growth profile. But I guess pre-pandemic and during the pandemic, they spent about $1 billion on CapEx per year. Well, this year they're spending about $1.5 billion on CapEx, but they're not building any more stores. It's really just because inflation ran so hot that the CapEx number went up quite materially, but the depreciation number hasn't gone up nearly as much. So you have a wedge, and a pretty sizable wedge between those numbers. There's some idiosyncratic factors for that. It may actually come down a little bit next year, but the point is the same, that the wedge has gotten pretty sizable. So investors that are looking at earnings and earnings power of the business may actually be overestimating, especially in a time of inflation, where you're going to have to adjust for the much higher capital expenses that particular company and others have to basically incur in order to maintain their competitive position and essentially maintain their growth plans.
Okay, so that's the accounting. Put your investor hat back on. I suppose, management teams know that investors are razor focused on margins and how well companies are able to increase the revenues in line with increases in input costs. I can imagine that management teams might make some choices to preserve that margin, maybe by delaying some of that CapEx. Are you seeing that as well? And as an investor, what do you need to do in order to account for that in your analysis of businesses?
Yeah, I think that's an interesting question and interesting point. And I think you're right that a lot of investors do look to margin maintenance, right? Margin percentage maintenance. Is this particular business maintaining gross margins? Is it maintaining EBIT margins? Is it maintaining EBITDA margins? Wherever on the income statement you want to take that margin. And I guess the point that you can make is that it's not enough to maintain that margin, right? Because again, you're looking at the income statement impact, and that income statement reflects historical costs. So unless you are actually increasing the margin to reflect the cash flow impacts, then you may not be keeping up with inflation.
Okay, interesting. Let's move to the second one, which, if I remember you correctly, was on inventory. Let's talk about that.
Yeah, another great question. So inventory is the second major area, and cost of goods sold, the second major area that we're watching on a go-forward basis. So maybe just take us all back to accounting class. There's three ways of accounting for inventory and cost of goods sold. So the first is FIFO, then there's average cost, and then there's LIFO. So FIFO is first in, first out. It assumes that the inventory you bought first, it could be a couple months ago, it could be a year ago, is the first inventory out the door. So under that method of accounting or that accounting choice, you're going to have the lowest cost of goods sold and the highest inventory balance. The exact opposite end of the spectrum is LIFO. So that's last in, first out. That assumes that the inventory you purchased most recently is the inventory that goes out the door first. And in that case, you're going to have the highest cost of goods sold and the lowest inventory balance. So how does this relate to inflation? Well, in an inflationary period, you are going to be spending a lot more in inventory, right? Your inventory balance is going to go up. And for businesses that are using FIFO, so that's when the inventory balance is highest and the cost of goods sold is lowest. Well, the cost of goods sold that you're putting through on your income statement is actually not reflecting the cost of inventory that you have to purchase. So what you're going to get is a lagging effect where the next period, potentially 2023 or 2024, your cost of goods sold is going to go up. And if you don't raise your prices, then you're going to have a potentially a material reduction in gross margins. So that's the one that we're really watching. And I think investors are somewhat attuned to that. I mean, the difference between FIFO and LIFO is pretty well known. But I think maybe less appreciated is that for businesses that are using FIFO, they have a choice to make. They have to raise prices after the inflationary period has passed in order to maintain their margins. So that's where the timing gap comes in. It's not good enough to raise prices this year or to maintain margins this year because the impact is going to flow through later. And actually, one of our portfolio holdings in the U.S. equity strategy was a perfect example of this. It was Johnson & Johnson. I think it was in their Q3 results. They actually explicitly mentioned this exact phenomenon. They said that expect margin pressures in the coming year because of the cost of inventory that we've purchased this year. So again, spreading that, reflecting that impact on a lagging basis.
But contrary to your example, they're effectively admitting that they're not going to be able to raise prices after inflation has, if indeed it does, has come back down. Is that right?
That's what it sounds like. Yeah, that's what it sounds like. If they're indicating that the higher cost of inventory is going to flow through later and that's going to have a negative impact on margin, well, yeah, that can only happen if they haven't raised prices to adequately offset that.
Okay. So you've basically described this first punch from inflation, which is, just higher costs. And that's maybe the more obvious one. But then these nuances with respect to the accounting, sort of the second punches that may be felt with a lag. Can you just help calibrate for me? Am I right to think that it's the first punch that's the more meaningful one, and these second ones might be just more marginal, or do you think they are actually quite a bit more meaningful than that?
It depends on the business. It really depends on the business model, right? So businesses that have high capital intensity, well, we're really going to be looking at the CapEx and the depreciation. That's a very obvious one to look for going forward. And as I mentioned earlier with Dollar General, it's very, it's quite apparent. They spent an extra $500 million this year alone on CapEx. Prior to the pandemic, they were generating about $1 billion in free cash flow. This year, zero. Right, so that's a very obvious difference that's materialized quite quickly. Businesses with high net working capital are the other obvious area. So again, maybe retailers like a Walmart or a Target. There, we're going to be looking very closely at inventory and the inventory accounting method to determine whether this is something that should be on our radar going forward. And you can imagine this can lead to really significant divergence in performance, even for two similar businesses. If you have, let's just call them X and Y. They're both facing the same inventory cost pressures. One uses one method of accounting, one uses the other. Yeah, you're going to have very divergent potential outcomes in year one versus year two. So that's something that you really have to watch for and adjust for. And it's unclear whether investors are doing this. There's so many investors in the market. There's so many actors in the marketplace. There aren't that many that, as per my understanding, are have the focus that we do, which is long only, long holding period, value oriented investors. So for us, it's a lot more important. And I can imagine a scenario where maybe some of the high frequency or shorter term investors that have a shorter time horizon, the stock prices do move around a lot more based on these numbers. So that is our opportunity to identify those situations, recognize that maybe there's a divergence between short-term performance or the short-term numbers and kind of long-term business prospects, and act on that.
Well, that's my major takeaway is just the short term or the heuristic to say, hey, a business is maintaining its margin doesn't give you the full picture. And so, Chris, thank you so much for joining us. And look forward to having you back soon.
Thanks so much. Appreciate it.